and how to research new companies coming to the market. Obviously a very hot topic this year with all the IPOs, and JJ earlier on in his speech mentioned I think it was 109 IPOs in the last 12 months, so it's a very hot topic. So can I welcome Dan Coatsworth, he's the editor of Shares magazine. Fred Walsh, he's the Director of Investment Banking at Panmure Gordon, and Jay Shaw, who's the CEO of NetDimensions. So, over to you, Dan.
Great, thanks very much, Mike. Good afternoon, I'm Dan Coatsworth, the Editor of Shares magazine. As Mike was saying, the success of Royal Mail's float has made IPOs a hot topic for retail investors, and the market for new floats has been very strong over the last few years. We're sensing that we're going to get another wave of IPOs coming to market over the coming months. So we structured today's panel about how to get a better insight into the world of IPOs, so you can understand the listing process and you know where to get information before you decide whether you make investment or not. So the structure of today's session will be Fred will talk about the world of the IPOs, and Jay will give his experience of bringing a company to market. And then it'll be your chance to ask question and answers at the end of the session. So if I could ask you, just wait for your questions until we give the nod, and we'll bring a microphone round. So, Fred, over to you.
Thank you. Firstly, I hope everyone at the back can hear me fine. I assume I'm getting a couple of nods and waves, so thumbs up is normally a good sign. So no presentation like this, although I've been told humour is not essential, it can really start without looking at actually the consumer environment and the economy and the various issues that surround that. I think the key thing from the point of view of IPOs to take away is that we are in a low interest rate environment. And why is that important? Very simply, it makes it more attractive for equities. We as a firm are optimistic about trading conditions. And I think one of the things that people need to remember is that the stock market looks forward. So the stock market is anticipating not what has happened, but what's going to happen with reference to what has happened. With regards to a few of the basic stats, you've probably seen these all before in the various publications. I think the key point really to bring out is consumer confidence has come back. We've also seen, with regard to disposable income, that there's been a little uptick in that. And I think the key point, and probably the most important of all, is that employment has been increasing. Now, this is the slightly more difficult one, where you can either look very clever or not so clever, depending on what happens. This is what is trying to look at what is likely to happen in the future and how that can affect your investment decision. If you look at the chart on the far left, I'll go into a simple version of this because we had a discussion with Stockholm economics faculty earlier in the week talking through these two charts. Basically what these are saying, you can see you've got US Treasuries, UK gilts and Eurobonds. If you look back to August last year, then the UK was more in line with the Euro area. Whereas if you look at it today, what we're actually seeing in the markets, and these are not equity markets, this is the market across the whole, for which the bond market is a proxy, we're actually seeing that the UK is currently more in line with the US, which is an interesting change. The chart here on the bottom left, so this presentation was written last week, and basically what this was saying is that we believe that interest rates will not rise before March 2015 or even later. Unfortunately, Carney, 48 hours ago, came out and said that already, so that's not really looking forward anymore. But I think the key point is that that low interest rate environment is something that's likely to stay, at least for the current environment. With regards to IPOs, there are also other things that you need to bear in mind, the one-off events. And why is this important? It's important because IPOs don't have a trading track record, which means actually confidence in the market it makes a big difference. There are various things here I've mentioned, and I realize these slides are going to be shared so we can ask questions about them. I think a couple of the ones to bring out, which are really slightly unquantifiable, is terrorism, Ukraine, what is or isn't going to happen there, and also a couple of weeks ago, if you'd asked me what was important about this, I probably would have said the election in 2015. I actually think it's more what's going to happen in Scotland on Thursday next week, which will be very interesting to see what's happened, because a lot of the companies with Scottish exposure have shown a huge amount of weakness in the stock market in the last week. If you've been to the LSE's presentation, then you will have seen these slides because they're taken from their data. It just shows what's happened in recent history. I think the key point to note is that if you look at 2009, you had a situation where there were very, very few IPOs, and the reasons for that are obvious. There has been a gradual uptick, and in investment banks, we are seeing a lot of companies who want to float, who are interested in floating, and at the end of the day, what are the capital markets there for? They're there to source capital to encourage growth. Now, this slide here is a slightly unusual one, and I've borrowed this off a friend of mine who's a management consultant, so the strange lines are not normally the sort of things you see in investment banking presentations. What this is trying to say is that the stock market for IPOs opened up in a very, very unusual way, and not in a way that is done in previous cycles. So our company worked on a software float of a little Irish business back in August 2011, which was incredibly difficult to do. And it was one of the first growth companies that actually came to the market here. And unlike previous cycles, what has actually opened up the market is the more aggressive, often technology-based media companies, healthcare companies, biopharma, etc. And the reason why this opened up the market is you've got a situation where one of the fund managers I talk to quite regularly referred to them as sex and violence deals. And the term is actually used more often than you would think, because it's deals where you have the potential to make 10 times your money on. So you have people who do a lot of work, look at it very carefully, and actually that got people excited about IPOs. And we had several that we worked on where actually the returns were quite exceptional. Then what happened after that is the recovery plays came in. So a good example of that are specialty financials. And then that led to the mid-cap players getting interest. So there's a bit of private equity interest there. You had some insurance deals coming through. And then, as Daniel mentioned earlier, large cap. So everyone knows about Royal Mail, what happened there. And actually, that was the start of, I'd say, a more normalized market. And then you had the value players, although arguably I'd put Royal Mail in the value box, actually, anyway. Good example of that is, I don't know if anyone knows Conviviality Retail. I think the original documents showed a deal. So Conviviality Retail, one of their segments is bargain booze. And it was quite literally, priced aggressively to get it away and was very successful in that. So what happened is you got a lot of deals coming through where historically what would have happened is the fund managers would start off a cycle by looking at the cheaper deals on metrics, whether it's PE, EBITDA, revenue growth, whereas actually they came later, which is quite unusual in the cycle. What we have seen, though, is if you kept this chart going into September, is actually all of these segments are in play. So that's the unusual thing, in that normally you'd expect probably value, then large cap, then maybe recovery, mid-cap and growth, or something like that. So it's happened in a very different way to what you would normally expect to see. The next slide, as I know this has been recorded, I have to be slightly careful what I comment on these different companies. I think the key point is here are a group of IPOs that have, should we say, good pricing metrics. And actually, all of these are quite well publicized, they're quite well known. And why is this interesting? This is interesting because we haven't seen this for quite a while in the UK markets. You've seen it a lot in the US markets, where you have aggressive valuations, but you haven't seen it to the same extent in the UK. If we look at the bottom left-hand slide, the other thing that's very interesting is that the demand from the retail environment for some of these deals has been enormous. So it's estimated that there was 4 billion of retail demand for Royal Mail on its own. Another interesting stat, which is impossible to prove, but something that we're noticing, is that normally when you price IPOs, you have a pricing range. So when a book comes in for an order, some people place orders at strike, some people place high orders, some people place low orders. What's interesting for the retail investor is that they are not in an environment where if their order's too low, people will be chasing them to push their order up. But what people need to remember is that an IPO gets priced at the lowest price that fills the book, which means if you want to participate in an IPO, there's a big advantage to putting an order in at strike. and you will know what the range is. So a sort of typical range for a LSE IPO might be something, make it in pence to keep it easy, sort of 100 to 115, that sort of range. So a strike order automatically gets filled if it gets its allocation, whereas if the deal price is at 115 and you put an order in at 105, you'd obviously end up with nothing. I think the other interesting point here is on pipeline. We're seeing a lot of businesses that are interested in coming to the stock market, and not just UK businesses, European businesses, businesses from Asia, and also, interestingly, from the US. And I think the US angle is quite interesting for the simple reason that the London Stock Exchange wins hands down, in my personal opinion, when you're looking at companies that are valued up to about $1 billion market cap. So for smaller businesses, I think the UK has a huge advantage. These are sort of pieces of research which have been published by various different houses. I think the key point here is that there are lots of different ways at looking at businesses, and actually the key to understanding how to value a company is working out what is the right metric to value a company. So the traditional ways are obviously revenue growth, which has become very popular, very prevalent in the US. Earnings, the classic way that's been around and is always an ideal reference. EBITDA, and also what people call as a unique investment opportunity. Sometimes that's because people can't work out quite why they should pay that on standard metrics, but actually what it's saying is, we think this is a good deal, we think you should price it. And for some of the companies that don't have a track record, at the end of the day, the metrics aren't necessarily the best guide to whether it's a good investment or not. This is something which I'm conscious has been talked about in other sessions. I think the key point here is that if you are a company looking to float, there are various issues, and whether you float or not is not necessarily saying something about your company. It's just really what is appropriate for your business. And I think as an investor, understanding what the drivers are and why IPOs may or may not be the right thing for a business actually helps you, in my opinion, to evaluate whether they're a good investment or not. This is something which there's been various discussions about. I think that the generic timetable for an IPO is simplistically about 4 months. In reality, they normally take a lot longer than this because there's getting to understand what level of pricing you'll achieve, what level of dilution you're willing to have, getting the company ready for IPO itself. But the key points are, which apparently there's been a bit of interest in, really just preparing documents so that you have an adequate amount of due diligence to mean that when you have your admission document or your prospectus, the idea is that in that document, everything is needed for the reasonable investor to make an investment decision. And that's ultimately what you should base your investing decision on. Here is a quick summary, looking at the main market, standard listing on the main market and AIM. So the differences here is that premium is the one that everyone thinks of, so all the FTSE 100 stocks. Main market also has a standard listing. The difference in this is it means that if you don't have, for example, a 3-year track record, you still have the ability to list on the main market. And the third one is AIM, which last year was the best performing index. And actually, it's performed very well. And there's a reason for this, and that's very simply because you have smaller growth companies. So by definition, it's easier to get a higher return on a smaller business than it is to get a higher return on a larger business. There's a session outside which the LSE have been doing on trading. So for those of you that do your own trading, I'd recommend going along and talking to the stock exchange about this. I think the key thing to understand here is that trading has actually evolved hugely. I think the best way to understand how the market works, if you're London-based, is actually you can register and go along to the London Metal Exchange, which is an open outcry pit, a trading pit, so it trades in metals. And it's a very good way to understand how the systems work. The key point really is this, is that back in the 80s, your traders would normally be rugby players because they're bigger and they can shout louder and they can reach over people. So this guy here is actually a guy that I think my boss knows, who lives in a big house, retired at 35 with lions on his gate, and likes playing rugby and drinking lots. And then this guy here is probably a physics grad from one of the top universities or a maths student. And the difference is that because of the old systems, the trading meant that actually, you had to reach in and get your order, and you had runners that had to get the orders across. So sometimes if you watch some of the old films about the stock market, it actually gives you quite a good idea. And this has been replaced by technology, which means the market has become incredibly efficient, and actually is something which, shows how efficient markets can operate. So it means as a private investor, you can get in, use the systems, and actually compete against these guys because you can get real-time information very, very quickly. A couple of comments here about what we feel makes attractive investments. I think this is, in a funny sort of way, what I see as a good way of having almost a tick box check of, if you're looking to invest, and particularly in an IPO as well, because you don't have the historic track record, the sort of things to look for. I think the first thing is actually to think about what the fund managers do. The fund managers do this for a living. They're doing it every day. They do a huge amount of work. And at the moment, what we're seeing on the sell side is that the buy side are keen on growth. And actually, I think that's something that is very important because ultimately, growth is priced at a premium. So if you invest in something that has growth potential, you have the risk issue. And at the end of the day, within your Markovitz portfolio, it's always a question of what is your level of risk. But growth gives you the ability for higher returns, as simple as that. Earnings visibility is also important. The key point on this to realize is some companies actually have a very good idea what they're going to make 6 months, 12 months, 24 months later. And a company that knows what its profits are likely to be within quite a small margin for error is far lower risk than one that doesn't know from day to day. So I think earnings visibility is important. The other thing is management and the board. There are a lot of interesting companies here today, and there are a lot of management and board teams on different stools. It's actually quite a good way of getting a feel for, do you think these people have the ability to make this happen? Because at the end of the day, you're paying a manager to effectively run a business, and the shareholders are the owners of this business that are backing his views and his strategy. So I think that's something that's very important. Industry dynamics, these vary. Disruptive technologies, where you have a sector where there isn't a lot of competition. Also, where you have a sector where there's the potential for macro growth. So you always need to go back to the economy for a little bit and think, well, at the end of the day, if the economy is going to do this, what type of sectors are likely to benefit in that environment? Quality of customers is also important. Barriers to entry. Can someone come in and replace their business very quickly and very easily? And at the end of the day, the most accurate way is cash generation. If you can value things on a DCF, which is looking at forward cash, which obviously you need a crystal ball to do accurately, then ultimately you should come up with the best metric for evaluation. So hopefully there's no one from the Telegraph here today, because I borrowed an Alex cartoon. I think the interesting point about this, I don't know if there's anyone who reads this paper, but there are several of the financial journalists and who have cartoons, and actually they're frighteningly accurate in what they do, and it's quite worrying how accurate they are. So the key point here is that really what we're seeing is that there are lots of interesting companies who are looking at IPO. And I think the difference from the audience point of view, if you're an investor, is that back in sort of 2008, 2009, 2010, there weren't that many companies looking to IPO. Now there are a lot, and they vary from the very big, very successful, well-known brands to the tiny, sort of very aggressively growing companies that have a sector niche. And I think the point that's interesting is what an investor at the end of the day, what do you want? You want return and you want choice. So if you have choice and you can pick well, the potential for returns are very high. Last slide here is talking about what we structurally do on an IPO and the way in which we set it up. I think the key point here is, for those of you who haven't had that much experience in the investment banking world, what we are trying to do is we give deals to the fund managers who have done some of the other presentations and try and persuade them that it's a good idea, they should take them. And why we are quite keen on this current environment is we're seeing lots and lots of opportunities for IPOs. And what you need to remember is that you need to think about your risk, your return, you need to think about how you structure your portfolio. But if you can pick well, the returns are very good. And we did a little exercise in our office just looking at all the IPOs that raised above 5 million this year, which is pretty much most of them. And if you invested across the board, and this is from the ones that have gone up 100% to the ones that have gone down 80%, we worked out you'd be about 7.7% up. So from that point of view, if you can choose well in that structure, in that environment, then the potential for returns are very high. The next section of the presentation is going to be passed over to Jay Shaw, who's going to talk to you from a company side about some of the issues of IPOing.
Thank you, Fred, and thank you, Dan, for inviting me today. Mine is going to be very short, very sweet, and I promise I won't talk about Scotland. Will not. I want to talk about three things. Our experience pre-IPO, a little bit, nominated advisors and governance, and then finally fund managers, care and feeding of. So pre-IPO, the slide that Fred showed was, at least in our case, would have been extremely optimistic. It was more than a year from deciding to list on the London Stock Exchange AIM until the day we actually floated. And it was not exactly what I expected. I have to say that the audit issues were extremely thorough and extremely well done. And I'll give you a couple of examples. So on the legal side, the lawyers didn't do spot checks. They didn't check just recent contracts. They checked literally every single document, every statutory claim, every contract we'd entered into from the day we became a business in 1999 to when we listed in 2007. They did a very, very thorough job. And maybe part of that was because we weren't a UK company and they just wanted to be sure. But I was extremely impressed. And to just say two points about that. One, the lawyers who came in for the final signing ceremony had so many documents as backup that they wheeled the documents in a suitcase. And the second thing that I thought was very interesting was a very small point. One of the lawyers, actually K&L Gates' lawyer, called one day and said, "We can't find the work for hire agreement with the graphics artist who did your original logo sketches in 1998. Do you think you could dig that up?" And I thought, wow, this is really serious. So there is a thought that there's greater due diligence or greater care taken with IPOs in the US, and I can tell you that's not at all true. Second point about the nominated advisors, I think it's a brilliant system, actually, because the frontline regulators for all the companies are people who will lose their licenses if they make mistakes. And so they are very involved, not just pre-IPO, but at every step, every quarter, practically every month, in making sure that the companies are doing the right thing and doing it well. And as a retail investor, I think that has to give you heart. That's a good thing to know. And then the final thing I want to mention is when we did our pre-IPO roadshow, we were all very excited, senior management, and we were very happy to tell our story. And the fund managers were not quite at the same level of exuberance. And they were listening to story after story. They get pitched constantly. And I thought, oh, this is challenging. This is very difficult. But now, after having been listed for several years, I realize just how good they are at their jobs. And I would say, as somebody who's been on both sides of the table, that if you find a fund whose description is like how you like to invest, I would pay very close attention to what that fund invests in, because there might be some good pointers for you. And that's all I had to say. Thank you.
Great. Thanks very much, both of you. Before we open the question and answer session, I just felt it's probably worth touching on one point that you can see there's clearly a lot of work that goes on behind the scenes before a company floats. But from a retail investor perspective, the first chance they get to properly see the information that goes into emission documents or prospectus is arguably after the company's hit the stock exchange. The shares have started to trade. You know, from my perspective, you can't thoroughly research a company unless you've read all these documents. So I don't know, Fred, is there anything that's happening in the industry where potentially there could be a change to the system that you have, say, a 48-hour window where all these documents have to be in the public domain before the shares start trading?
So there's 2 points here. If you're a fund manager on a roadshow, what happens is a couple of weeks before the float, you will get a document written by a house like ours or one of our competitors, which is a research piece, basically taking an analyst's view on the company. And the reason why these are not generally available to the public, although people can go and buy them off certain firms, is that people take the view that actually, after what happened in the US, you know, it's a protection for the public, because just because a very well-respected analyst says you should buy the stock, it doesn't mean you should. The reality is this, is that the investment decision should be made on either the prospectus or the admission document, and they should be up at midnight the night before the first day of trading. The issue comes is that, you know, if you want to wait up till 12:01, you've then got 8 hours to effectively digest it, read it, and make an investment decision if you haven't had any foresight or you haven't had the ability to access the information before that. I think the problem is that the majority of investors in IPOs are institutional fund managers. I think pre-Royal Mail, you'd have to go back to the 70s and 80s to get large retail interest. I think the point is that if, for example, and it's a slightly political issue, the documents were ready 48 hours before, then arguably, you know, if the private investors got the time and the sophistication, then they would be able to analyse it.
Okay.
Yeah, can I add?
Yeah,
so one thing in our experience was that the house analyst did a brilliant job. He really understood the industry. He understood where we were in it. But obviously, only qualified buyers could read that research. More recently, we've actually contracted for paid research, which doesn't have a buy or sell recommendation, but does a very good job on industry analysis. And if I could turn back the clock at all, I would have had some of that much earlier on.
Well, I guess people see that if you participate in Royal Mail at the IPO before it's, and you put your order in it and you got your allocation, clearly on the first day's trading it went up a lot. So I guess are retail investors rushing in thinking that I'll buy everything without doing any proper research? But I was wondering, is there a way for retail investors to take part at the IPO price if a company is not doing, say, what Merlin or Saga did? Is there anything
there are two issues. The first one is that to make a public offer, you need a prospectus, and not all of these deals have one. So if they don't, it can't be a public offer. What you can do, and which is another way of looking at it, is that you either invest in a fund that invests in these types of ideas, or if you are sophisticated enough and you have a broker that looks after you, you can say to your broker, I'd like to participate in these IPOs. They can deem whether you are sophisticated enough and actually have an appropriate enough wealth to be able to be involved in these sort of deals. And that's a way of doing it. So, for example, I won't say the name of the fund, but we got a private order from the office of a little town in Surrey, which you probably haven't heard of, for $500,000 from one person who is an expert in a particular industry, who basically said, just broker, I know this company, I just want some. So, it's one of those situations when that's £500,000 from one person. So the key point is that if you have the level of expertise, the rules are there to protect you, but you can demonstrate that you have the level of expertise, and there are various ways around of doing that.
Yeah. So we'd like to open up the floor now to any questions that you may have. I don't know if there's a microphone that can go around, or so is there anyone got any questions that they particularly like to ask us? Or would you like me to? I've got some more here. Yeah. The gentleman in the front here. So.
I was wondering whether you could comment on the biggest IPO that ever will occur on the New York Stock Exchange soon of Alibaba. Would you recommend a retail investor to participate?
Well, I don't think we're allowed to answer that one. But
let me put. I'll answer this away, which will sound like a politician. I think we can't give you advice because that's not appropriate within the remit of what we're operating. I think the key point is that if you have disruptive businesses, the potential for large returns are large, but I would argue that the bigger the company is, the less the potential for it to turn into a 10-bagger. So, at the end of the day, I remember, when I was studying at university, there was a very impressive Indian professor who said to me, if you're going into the city, one basic rule, divide your stocks up into 20, make sure they're in different areas, and you'll probably get about 85% of the diversification of a fund. So I think that's a good way to look at it. So if you have £20,000 to invest, there's an argument that you shouldn't be spending more than 1,000 on any one share. And I think if you go by those rules, at the end of the day, it's risk and return. Then, if you pick well within that parameter, you probably should perform quite well as well.
Okay. Another question there.
Hello, I just have actually one question. So you mentioned prospectus. So how do you actually access these things?
So
where do you actually search for them generally?
So you can find them online. You can go to the company website, and they're available there. There's also a link through one of the other websites that aggregates them online. I can't remember exactly which one it is, but if you know the business, it should be on the company's website. So you'll have an investor section where you click on, and you'll have a financial section which you can access this. The problem is that they are meant to be there at midnight, always the night before.
And it's not.
Without mentioning names, there are examples where that hasn't happened.
Yeah.
So, and that is perhaps an issue.
Yeah, that's exactly the issue that I was actually facing, because there wasn't information or nowhere where I could search for it. Second thing was, how do you actually get to know the first trading date?
So a good way is actually through the press, because you'd be surprised. Most companies want people to know they're floating. So actually trawling through the financial press, Gentleman's Magazine on my right, also all the broadsheets as well, will actually give you a good feel for what's going on. So that's quite a simple way of doing it.
I mean, what they tend to, if you look at the stock market announcements, the RNS, Regulatory News Service announcements, which you can find on a wealth of different websites, if they're coming onto AIM, they should give a Schedule 1 announcement. So roughly that says it could happen in 10 days, and there'll always be a date on. Inevitably, if those dates get pushed back, they'll put an announcement out. If it's coming onto the main market, you'll see, again, there'll be announcements to say, this is an intention to float, we're going to float. They probably won't give a date then, and then you just keep an eye. It could be weeks or perhaps a month. They'll put, this is the offer range, and perhaps a couple of days later, this is the offer price that's been agreed. Inevitably, it'll start trading either that morning. So the announcement will be out at 7 o'clock, and they'll start trading at 8, or they might give you a couple of days' notice.
So just on that, I mean, we refer to them as the 10-day announcement. Basically, 10 days before you float, you have to have made an announcement that you're going to float. Mm-hmm. So it can be longer than that, but it can't be shorter than that. So actually, that's probably the most foolproof way to look at it.
Yeah. Thank you.
Okay, any questions? Gentleman front here.
Quindle PLC, they were about to launch on the main market from the alternative investment market, and they were refused entry because they had so many fluctuations in their share price. What do you think about the company?
Well, I think the problem is that where we're sitting, we can't, give advice that's going to be recorded.
No advice intended, just your comments, maybe.
In specific companies. I think if you want to ask that question, the best thing to do is there's about 8 fund manager stalls, and actually they'll probably give you 4 different views, but it should give you a bit of a feel. So, and they'll be very happy to give you their views as well, probably try and sell you a fund as well at the same time.
Shares View, well, yeah. Come see me afterwards, I'll tell you. Shares View, yeah. Any other questions? Perhaps someone from further back. I can't see very well the lights here. Okay, there's a gentleman just on the end there. Thank you. Thank you. Last question as well, sorry, because of the time. But if you need to talk to any of us, we'll be outside after the session after this one.
Yeah, I have a quite basic one. As the gentleman just mentioned, as a UK investor, how easy it is to participate in the overseas IPOs like Alibaba or any stock like that? Thanks.
Well, I think that's most stockbrokers, UK-based stockbrokers, will offer overseas share trading. Anything on NASDAQ or New York Stock Exchange should theoretically be dead easy to do. They'll probably say that you want to have the stock trading first. I don't know the details of that exact IPO, whether there's any opportunity to participate, like an offer like Merlin or something. But you shouldn't have trouble accessing big names once they start trading.
But the simple example is you will have a broker, I assume. Talk to your broker, and they can help you to do it. That's the best way.
Okay, thanks. And sorry, obviously there's lots more questions, but we've run out of time now. So if you need to ask any questions, we'll inevitably be around for the rest of the day. Come and grab us. Thanks very much.